Investment performance is the only thing that investors care about. Without it, your trading 2-on-2 portfolio would be just as useful as a chocolate fudge fireplace come your retirement. So in light of not having our investment returns melt away and actually making some good money using this thing called investing, let's take a look back at what history tells us is the best place to invest our money. Welcome to the 1930s, where a cup of coffee was a penny, petrol was 16 pence a litre, a pint of beer was 2.5 pence, and the average wage was just £3.60 a week. We've entered the heart of the Great Depression with widespread poverty and the biggest market collapse in stock market history. But if all the way back in the 1930s you had yourself just a few shillings to invest, well, as of right now, you'd be doing pretty well for yourself if you were still alive. I'm alive! But that largely does depend on what investment that you made. So now let's go back in time and take a look at each of the individual asset classes and what returns they provided. One of the world's natural and scarce resources, gold is always deemed to be a store of value. It's one of the ways that investors can diversify their risk by buying a solid block of gold bullion from your local Costco, or more recently, buying something called an ETC. Now, an ETC stands for an exchange-traded commodity. It's similar to the purpose of an ETF, which is an exchange-traded fund, and it allows investors to generally track the price of gold, giving you access to the properties and security of owning physical gold without having to have a vault of gold bars in your house. Now, whilst it might be cool to own the physical stuff, it's not exactly practical or perhaps even safe with some of the light-fingered bastards roaming around the streets of the UK. So if I were to invest in gold, I'd probably do it through something like an ETC and just look at my numbers on a digital screen instead. And also, don't personally hold gold within my own investment portfolio. It's been a well-loved investment of the past. So much so that even Elvis Presley once owned 3 gold-plated cars. Some might say that's a smart way to counteract a depreciating asset, whilst others might say it's just stupid.
What are you, stupid?
But nonetheless, some people do make serious investments in precious metals. The gold rush of the late 1940s showed just how many people wanted to get their hands on the stuff as a valuable asset. But just how much has gold gone up in price by over the last century? Well, in the 1930s, gold actually traded at $20 an ounce. Fast forward to 2024, we're trading at $2,016 per ounce. That's the equivalent to a gain of 9,980%. In practical terms, a £1,000 investment back in the 1930s would have allowed you to have achieved a compounded annual growth rate of 5.03%. Today would be worth £111,979. Do you think that's a good return on investment? Well, now let's take a look at some of the other asset classes and we'll find out. The London Stock Exchange is one of the oldest stock exchanges with history dating back over 300 years. The trust of the stock market was built on the saying, "Our word is our bond," which allowed stock traders to buy and sell shares in a less regulated fashion. Now get this, back in the day, the UK stock market only actually had about 140 listed companies, with a combined market value of £4,250,000. And about 3/4 of that market value belonged to 6 of the most important companies at the time. Sounds like the same level of concentration risk as the US stock market has today. But risk appetites to one side, those numbers have risen to now 1,918 publicly listed companies for a combined market value of $2.53 trillion in today's money. So we've come a long way since the origins of the UK stock market, but how exactly has it stacked up as an investment? Well, firstly, I found it bloody hard to find any kind of long-term statistics about the performance of the UK stock market, and that was because the FTSE 100 only actually formed in 1984. So the bulk of the data out there does just align to that point in time as the most historical point. But after doing some digging, I found this report from the Investors Chronicle, which provides some more insightful detail. Take a look at this chart. It shows the distribution of inflationary adjusted returns of the UK market between 1900 and 2023. You can see that most frequently the market generated between 3 and 9% in returns, and it did so about 21 times. But closely followed that was returns of 9 to 16%, which happened on 19 occasions or 19 years, but also between -3 and -9% on the same number of occasions too. So what exactly does this data tell us? Well, it does show that the average long-term rate of return of the UK stock market is about 5.5%, meaning a £1,000 investment back in the 1930s today would be worth £173,840. Now, you won't believe this, the average price of a UK property in London back in the 1930s was about 350 quid. And nowadays, you can barely rent a parking space in London for that price. Back then, 85% of new houses were sold for less than £750, which is about the equivalent to £45,000 in today's money. But in contrast, after World War II, or between about 1950 and 1970, this is where things started to get out of control, because the average house price grew from £2,000 to £5,000, an increase of 150%, or the equivalent to a gain of about 7.5% per year. My nan tells me stories about back in the day where her and my granddad bought their first home for about £1,000 and paid just £1 a week on their mortgage payments. And this is where it's so hard to imagine what the future price of property will look like, perhaps another 40 or 50 years into the future. But I guess just know this: it will be several times the prices that we see today. And this can certainly be reflected in the acceleration in house prices that took place during the 20th century. Because between 1970 and 1973, where I have official data from the land registry, house prices actually doubled in value from £4,000 to £8,000, all within the space of 3 years. And that kind of spiraling increase of UK house prices kind of only goes up from there. If the average house price was about £350 in the 1930s, and today the average house price is £284,691, well, I worked that out to be a compounded annual growth rate of 7.39% per year. Meaning, hypothetically, for every £1,000 that you invested in UK property back in the 1930s, today that amount would be worth £1,017,690, which perhaps slightly controversial, but is a far better rate of return than the UK stock market has to offer. Now, a bond is a financial product that represents a loan made by an investor to a borrower, which can typically be a government or corporation. So basically, it's the purchase of debt in return for a return on investment. And governments really do love their debt. The US government is currently sat on $34.2 trillion worth of debt and is rising at an astronomical rate of knots, and is actually the equivalent to $101,958 per person. The UK government, on the other hand, isn't in as quite a bad a situation, where we only have £2.5 trillion worth of debt, the equivalent to £37,900 per person. So if we allocated all of the government debt on a per head basis, the UK is in a proportionately better position than the US government. But nonetheless, it's obviously still not great. Now, of course, governments running in this deficit need to continue to raise money in order to continue to pay for public services. And to do this, they sell bonds to the public or us as investors. Now, again, I couldn't really find much information about the long-term UK gilts market, which is the equivalent to the UK bond market, but I was able to find some longer-term investment returns from the US T-bills or Treasury bills, which are the US equivalents of their bonds. Now, for context, bonds are issued over different durations of time, and therefore, depending on the duration of time that you lock your money up for, will largely depend upon what rate of return that you can expect to achieve. Typically, the longer that you lock your money up for, typically the higher rate of return. Now, the average rate of return on a 10-year Treasury bill over the last 100 years works out to be a compounded annual growth rate of 4.57%. Meaning a £1,000 investment into a US Treasury bill back in the 1930s today would be worth £72,790. I certainly think that this low risk profile of investment is certainly reflected in its longer term investment returns, which, depending on your overall risk appetite, may actually dictate your overall appetite to hold bonds within your investment portfolio. Fun fact, the Great British Pound is actually the oldest and longest standing currency on the planet today, and actually dates back to the Anglo-Saxon times about 1200 years ago. And whilst in that era it was used as a mechanism to exchange value, nowadays our pounds and pence aren't exactly worth what they used to be. The actual value of our cash is actually becoming more and more worthless by the day. To provide you with some context, since the 1930s, inflation has eroded 98.75% of the value of the Great British Pound, meaning £1,000 in cash in 1930s would be worth the equivalent to £12.56 today. It's actually the only asset class that I've come across that would see the value of your money decline over the last 100 years, which I guess makes investing your money all that more important. Did you know that back in the late 1800s, it actually took over 2 weeks to get stock prices from New York to the UK? Thank God for providers like Trading212 who can give us live market pricing at our fingertips. Now, the US stock market has performed pretty well in most recent years, especially when benchmarked to the UK stock market. In actual fact, you would have had to have gone all the way back to the 1980s, which was the last time that the FTSE All-Share Index actually consistently outperformed the S&P 500. But since roughly the 1990s, the US investor largely performed better over a rolling 5-year average. But what exactly do the longer term numbers tell us? Well, according to officialdata.org, the average rate of return for the US stock market between 1930 and 2024 works out to be 9.78% per year, with dividends reinvested, meaning a £1,000 investment in the US stock market today would be worth £9,470,520, which is absolutely insane. And it probably makes you go and think about, well, how can just getting an extra couple of percent per year result in multi-millions of pounds more added to your investment portfolio? And well, that's the power of compound interest, a concept that very much still blows my mind to this day. So look, fast forward to 2024 and this is where we're at. 100 years later and the Great Depression has been rebranded to a cost of living crisis, and the US stock market very much remains to be in a bubble. So I guess some things never really change apart from the price of goods, because a cup of coffee now from Starbucks is about £4, petrol is £1.45 per litre, and a pint of beer is about a £5, and the average wage is £682 a week. Now, whilst these normal household items have gone up by an astronomical amount, and admittedly wages not by so much, now let's benchmark all of the different investments that we've talked about so far. US stocks are by far the best performer, certainly by some margin, followed by UK property, UK stocks, gold, bonds, then cash. Now, of course, past performance isn't always indicative of future results, but sometimes it's interesting to map out the past in order to give us some kind of direction of where we could potentially go in the future. Now, if you do want to know more about how I managed to grow my own personal investment portfolio to over 6 figures, then be sure to click on this video next. Be sure to subscribe to the channel on your way out. And with that being said, see you over in the next one.